Welcome to the workbench. Last time we built a company, a full 3-statement forecast with an AI assistant doing the heavy lifting. Today we are going to evaluate 3 different valuation methods, 3 different discount rates, and if we have done it right, one single equity value they'll all agree on, down to the last euro. Let's see if that's true. Here's where we are headed. This is the finished model, and this little table is the payoff. Equity value by the weighted average cost of capital method, 146,307. By adjusted present value, the same number. By flow to equity, the same number again. 3 completely different roads, and they land on the same spot, to the cent. By the end of this video, you'll have built this. And we will add also 2 additional scenarios, and you will know exactly why those 3 numbers can't disagree. Quick recap. This is exactly where episode 1 left us. Income statement, balance sheet, cash flow, all balancing. But I've made 2 small changes that matter a lot for valuation. First, the actual last year numbers now live in their own dataset, last actuals, with no scenario axis, because history doesn't change when you run a what-if. Assumped now holds only the things that do vary by scenario. Second, look at the cash line in the cash flow statement. It's flat. That's deliberate. When the company generates free cash, it pays it out, and when it needs cash, it raises it. Cash stays flat on purpose, which is exactly what lets the whole valuation ride on free cash flows, and nothing else. To discount anything, we need a cost of capital, and for that we need the company's risk. It's beta. But our company is private, it doesn't trade, so we borrow it. We take 2 listed peers, call them Tusk and Sangyo, and we strip their financing out to get at the underlying business risk. Let me type their numbers in. Tusk, equity beta 1.2, debt beta 1200ths, debt 30%. Sangyo 1.4, a fifth, 40%. Now, some formulas I'll actually write by hand. The unlevering. Asset beta, for peer companies, equals equity beta times the equity weight, plus debt beta times the debt weight. Average the 2. And there's our asset beta, 0.898, and then CAPM does the rest. Risk-free rate plus the asset beta times the market risk premium. So we get the unlevered cost of capital for the companies and for the industry average. In Valpa rounds, the beta U is taken from the industry average we have just computed. Let's put the whole chain in one picture. We start on the left with our 2 peers, their equity betas, their debt, their leverage. We unlever each one and average them. This gives us the asset beta, 0.9. Feed that into CAPM, risk-free rate 4%, market premium 5.5%, and we get the unlevered cost of capital, RU, 8.94%. It's the anchor for everything that follows. Now we add the leverage back, relever the equity, Modigliani-Miller proposition 2, and the cost of equity climbs to 11.94. Equity holders take the business risk plus a premium for the debt sitting in front of them. And finally, blend equity and after-tax debt together, the weighted average cost of capital, 8.32%. Notice it sits below RU, and that gap, that little discount, is the tax shield that's evidenced in the alternative formula below. We'll come back to that. It's the king of the whole episode. Here's where the assistant takes over. I'm not going to dictate formulas. I'm going to describe what the dataset should mean in plain finance and let it ride the machinery. Watch what I asked for. Cost of debt from its beta, the debt-to-equity ratio, relever the equity by Modigliani-Miller, then the WACC, and the shortcut for the WACC as a cross-check. Now the model's reasoning is unfolding. Every passage is cross-checked against the data. And there it is. Cost of equity 11.94, WACC 8.32, and the shortcut agrees to the last digit. That agreement isn't luck, it's an algebraic identity, and it's the assistant's own proof that it relevered correctly. Now the first actual valuation. I've asked for the benchmark, discount the free cash flow to the firm at the WACC and get the value of the whole company. 3 ideas are doing the work here, so let me name them while it builds. First, we can't forecast forever, so at the end of the horizon we drop in a continuation value, the last year's EBITDA times an EV to EBITDA multiple. A simple, defensible anchor for everything after the forecast. Second, the discounting isn't a big sum, it's a backward recursion. Each year's value is next year's cash flow plus next year's value divided by 1 plus the rate, written once with the next year reference, and the engine rolls it back from the horizon to today. And third, the assistant also computes VU, the exact same cash flows but discounted at the unlevered rate. That's what the business would be worth with no debt at all. The zero leverage baseline the next method builds on. Let's see the result. Lever value 243,846, unlevered 238,422. Take 40% of the levered value as debt, subtract it, and equity comes to 146,307. Hold on to that number. We are going to reach it 2 more times by 2 completely different routes. Before the next build, one picture, because it's the heart of the whole episode. This is the adjusted present value view. Start with the unlevered business, 238,000, then add the value of the tax shield the debt creates, about 5,500. That gets you to the lever value. Subtract the debt, and there's your equity. 146,307, the same number as before. But now watch what happens if we change how the company borrows. Same firm, same cash flows, but a fixed repayment schedule instead of a constant ratio. The tax shield is now safer, so it's discounting differently and the equity comes out higher, 153,000. Same company, different debt policy, 7,000 euros of difference. The method didn't move the answer, the financing assumption did. That's the lesson. So let's build that. And here's the elegant part of how the model's laid out. It's one dataset carrying 2 debt policies side by side. The assistant only writes the formulas that actually differ between them, the debt and the shield's discount rate, and every other line is written once and shared across both. That's the right way to model a comparison. Don't duplicate, parameterize. And the crucial choice is the discount rate. If the debt is fixed in advance, a set repayment schedule, the tax shields are about as safe as the debt itself, so we discount them at the cost of debt. But if the debt tracks the firm's value, a constant ratio, then the shields rise and fall with the business, so they carry the business risk, and we discount them at RU. Same idea to different risks. There's the result. The constant ratio equity comes back to 146,307, matching the benchmark exactly, as it must. And the fixed schedule equity, 153,000, higher, and now you know exactly why. Third road to the same place. Flow to equity skips the firm entirely and goes straight to the shareholder. Take the free cash flow, subtract the after-tax interest the lenders take, add back any new borrowing, and what's left is the cash that actually reaches equity. Discount that at the cost of equity, 11.94. It's the most laborious of the three. It needs the full debt schedule and the levered rate, which is exactly why it's the best cross-check. If the debt in cash flow and the leverage in the rate ever disagreed, this is where it would show. And 146,307, third road, same number, not close, identical. Now let's prove it properly with independent checks. I'm asking the assistant to revalue everything a second way, plain spreadsheet net present value formulas, and tell me which numbers must coincide and why. And here's the whole episode in one table. Lever value by NPV matches the recursion exactly. Equity, three ways. WACC, APV, flow to equity, all 146,307, agreeing to the cent. That agreement is not a coincidence you admire. It's an identity you can prove. Same cash flows, same debt policy, three different arrangements of the same algebra. And notice the one number not shown in this table that doesn't join in, the fixed schedule equity, off on its own at 153. That's not an error, that's the control. A genuinely different financing assumption giving a genuinely different answer. If that one had matched, I'd know something was broken. One last thing, and here we take the leash off. Up to now, I've kept the assistant on a tight harness. Our datasets, our structure, our pipeline. Now I'm going to ask it to do the thing a certified analyst does. Explain the model. Not just the numbers, but the theory, the propositions, the debt policy debate, when a practitioner should reach for each method, and to ground every work in this model's own figures. Look at this. Before building the actual report, the assistant rehearses the general techniques to build reports in Impromptu. And look at what comes back. A proper teaching note, the peer analysis, the cost of capital chain, all three methods with the models tables, the reconciliation we just watched, with the actual propositions named, and the classic papers cited where they illuminate what's on screen. One thing it flags that I love, the exit multiple we use quietly implies a growth rate of about 6%, worth arguing about. That's not a formula filling a cell, that's judgment. That's the difference. One more, because it shows what the whole structure was for. The model was built scenario ready from day one, so let's add the best case and the worst case, just input numbers, growth rates, margins, betas, and I will not touch a single formula. The assistant is taking care of defining input values for the new scenarios. But look, there are some issues. 2 bugs were found. One is about the formula computing the average industry beta, and the other one is about the data from the predetermined debt schedule. The assistant is analyzing such issues. And he is finding solutions for both. Like in jazz, that's improvising. This app is called Impromptu for a reason. And there it is. Every valuation dataset, the DCF, the APV, the flow to equity, the checks, has recomputed for all 3 scenarios at once. Best case equity up here, base in the middle, worst down there. 0 formula edits. That's what the scenario axis was for. Describe the structure once, and every what if comes for free. And the receipt. Everything you just watched, the whole valuation built and explained, in 25 minutes of assistant time for about $13.50. That's the model, the 3 methods, and the teaching note. Not bad for an afternoon. 3 models, 1 value, and an assistant that can not only build the machine, but also tell you why it works. That's company valuation on the workbench. Next time, we'll make the model breathe a bit more, adding excess cash and overdrafts and all. But before that, we are taking a little detour. Tiny language models, made the way we make everything here. Pietro calls Paolo. You'll see. If this was useful, you know what to do. See you next time.